Hello everyone. Welcome to BYK Book Summary. I am Amin. Here we decode the inspiring journey, mental warfare, and empire building life lesson of the world's greatest legend. Today topics and their biggest secret are right on your screen. Let's dive in with my AI co-host.
Visualize the ultimate CEO.
Yeah.
Like if you take a second right now and actually picture what that looks like, you are probably seeing a very specific, culturally ingrained archetype.
Oh, absolutely. We all have that same image in our heads.
Right. You are picturing a charismatic visionary. Maybe they're standing on a brightly lit stage in a black turtleneck, effortlessly commanding an audience of thousands as they unveil the next world-changing product.
Or, if you lean more toward traditional finance, you're picturing the aggressive, table-pounding titan of industry.
Yes, the kind of person with their sleeves rolled up, barking orders on a trading floor, micromanaging daily operations, and just relentlessly pushing their executive team.
And they're probably obsessively watching the minute-by-minute stock ticker on CNBC.
Exactly. We have been so conditioned by Hollywood, by the financial press, and, well, frankly, by decades of business school lore to believe that the ultimate business leader is essentially a battlefield general.
A larger-than-life personality.
Yeah, someone who bends the free market to their will through sheer force of charisma, continuous expansion, and just relentless operational hustle.
Right.
It is a very comforting, very cinematic image.
It makes for a great movie.
It really does. But what if I told you that the most mathematically successful CEO of the 20th century was none of those things? What if I told you he was a quiet, introverted engineer who sat alone in a room, refused to pay dividends, actively shrank the size of his company, and managed to beat the S&P 500 by a staggering 180 times?
That just shatters the cinematic illusion completely. And, that is precisely why we need to deconstruct this archetype today.
Yeah.
The gap between what we perceive as effective corporate leadership and what actually generates unprecedented generational wealth is it's staggering.
It's massive. And that is exactly the mission of our deep dive today.
Right, because human nature inherently likes our leaders to be visible. We like them to be loud, and we especially like them to be visibly busy.
We equate motion with progress.
Exactly. We routinely equate vocal confidence with competence. But when you strip away the magazine covers, the theatrical product launches, the PR spin, and you look strictly at the raw, long-term numbers, well, a completely different reality emerges.
The data tells a totally different story.
It really does. The data suggests that the aggressive, highly operational general is often mathematically inefficient.
And we are taking a hammer to that charismatic visionary archetype today, because the research we're looking into, specifically drawing from William Thorndike's groundbreaking analysis in his book, The Outsiders, it reveals something absolutely stunning.
It's a completely counterintuitive finding.
It shows that the most successful business leaders in modern history were actually the exact opposite of that stereotype. They were quiet. They were deliberately, stubbornly contrarian.
They did not care about the daily operational hustle.
Not at all. And they actively avoided the spotlight. Instead, they were obsessed with a completely different, mostly invisible skill, a discipline called capital allocation.
Capital allocation, yeah. It is a phrase that sounds incredibly dry, perhaps even aggressively academic, but it is the central engine behind the greatest business success stories of the last century.
It's the secret sauce.
It is the dividing line between a company that merely survives and a company that compounds wealth at astronomical rates.
When I first started digging into Thorndike's data, I was struck by the sheer anonymity of these figures.
Yeah.
We were talking about 8 specific CEOs, people like Henry Singleton at Teledyne, Tom Murphy at Capital Cities, Bill Anders at General Dynamics.
Names that the average person has absolutely never heard of.
Right. These are leaders who generated wealth that makes the famous celebrity CEOs you see in the news look like rank amateurs. And yet they are virtually unknown outside of extremely niche institutional investing circles.
Yeah, it's fascinating.
How is it possible that the greatest wealth creators in history operate in near total anonymity to you and me?
Well, it is primarily because their methods were not glamorous. Their day-to-day reality did not make for good television, and frankly, their strategies do not lend themselves to exciting, dramatic biographies.
Nobody wants to read a thriller about a guy sitting in a room looking at spreadsheets.
Exactly. What Thorndike did was look past the narrative and focus purely on the financial engineering. He studied these 8 unheralded CEOs and found a single unifying structural thread among them.
And what was that thread?
They all spectacularly defied conventional business wisdom. They ignored institutional imperatives, they ignored what their peers were doing, and they focused entirely on the rational, mathematical reality of how capital flows.
And it is worth noting that this exact book, in this exact philosophy, comes highly recommended by Charlie Munger.
Yes, that is a massive endorsement.
For those who might not follow the inner workings of Berkshire Hathaway, Charlie Munger was Warren Buffett's legendary business partner. He was a man famous for his absolute ruthless rationality and his utter disdain for corporate nonsense.
He did not suffer fools gladly.
No, he did not. When a mind like Munger's says you need to pay attention to these 8 people, you immediately realize that the conventional wisdom about what a CEO is actually supposed to do is fundamentally flawed.
So let's examine that conventional wisdom, because if you ask an average board of directors or, a standard business journalist what a CEO's primary function is, you will get a very predictable list of operational duties.
Right. They'll tell you it is managing people.
Exactly. Managing people, setting the strategic vision for the next 3 to 5 years. They will emphasize growing revenues.
Getting bigger.
Yeah. Getting bigger, expanding the physical footprint, capturing more market share, hiring more employees, opening more international offices.
It is an empire-building mindset. I mean, the underlying assumption is that bigger is inherently better.
That is the operational mindset in a nutshell. You are managing the massive, complex machine of the business. But the singular revelation of the data we are examining today is that this operational management, while obviously necessary to keep the lights on, is not the true job.
It's just the baseline.
Right. The real job of a CEO, the one critical function that ultimately dictates whether a company creates massive intrinsic value or slowly bleeds to death, is capital allocation.
I really want to frame this distinction because it is the foundation for everything else we are going to explore. Think about the difference between the person running a complex mechanism and the person designing the financial architecture of that mechanism.
Okay, let's break that down.
A traditional CEO operates a lot like a highly skilled, highly charismatic ship captain. They are up there on the bridge, white-knuckling the steering wheel, squinting into a storm. They're yelling at the crew to trim the sails, constantly adjusting the rudder to navigate the waves.
Making sure the engines are running at maximum capacity.
Exactly. They are completely, totally consumed by the immediate physical operation of the vessel. They are making sure the ship goes fast and does not sink before nightfall.
It is a very reactive, highly visible leadership style. I mean, the captain is essential for the voyage, but their perspective is entirely limited to the horizon directly in front of them.
Right. But the outsider CEO, the pure capital allocator, is not on the bridge at all.
Where are they?
They are quietly sitting in a cabin below deck, completely insulated from the wind, the noise, and the panic of the crew. They have a ledger open. And instead of steering the ship, they are looking at the company's balance sheet and making fundamental structural decisions about the fleet itself.
They're looking at the big picture.
Yes, they're looking at the profits the ship just generated and deciding, should we use this cash to buy a new, larger engine for this specific ship? Or is this current ship actually operating in a dying trade route?
Yeah.
And should we instead take the profits and buy a fleet of smaller, more efficient ships somewhere else?
Or even better, is oceanic shipping a terrible industry with low margins, and should we take the cash flow from this ship and go buy a highly profitable railroad instead? The distinction there is vital. The captain on the bridge is trying to win the race today, using the tools they have been given. The person below deck is analyzing whether they should even be in that specific race, what the optimal vehicle is, and where the capital yields the highest return with the lowest risk.
But I have to push back on this a little bit because it feels very counterintuitive to how human beings organize themselves.
How so?
Well, I hear what you're saying about the math, but a CEO's job is leadership. It is cultural. If you put a pure, emotionless numbers guy in charge, someone who just sits in a room running spreadsheets, doesn't the culture of the company just die?
It's a valid concern.
Why is the business world so stubbornly obsessed with appointing the operational captain if it is mathematically less effective? I mean, how do you maintain morale if the leader doesn't care about the daily operations?
You are hitting on the exact cultural friction that makes capital allocation so rare and so difficult to execute. The truth is, the corporate world is structured to reward operational hustle, not analytical patience.
That makes sense.
Think about the pipeline of corporate leadership. How does an individual actually ascend to the CEO chair? You do not graduate from a top-tier MBA program and instantly take over a Fortune 500 company.
No, you have to climb the ladder.
Right. You spend 20, 30 years climbing a deeply entrenched corporate ladder, and the metrics for climbing that ladder are exclusively operational.
You advance by hitting your quarterly sales targets, successfully launching a product, or, turning around an underperforming division. You advance by being an elite manager.
Precisely. You start as a junior manager, and you prove you can run a small team without everything catching fire.
Right.
You get promoted. Now you are a regional director. You prove you can execute a top-down strategy and marginally grow the revenue of your specific territory. Because you are highly competent at these operational tasks, you move to vice president, then maybe chief operating officer.
You're just proving you can handle bigger and bigger machines.
Exactly. For 3 decades, your brain has been fundamentally wired to solve business problems through operational exertion. You solve problems by hiring more people, firing underperformers, launching aggressive marketing campaigns, and driving sales volume. You are an absolute master at running the machine.
It is a profound compounding of behavioral habits.
It is. But the moment you are finally appointed to the CEO chair, the fundamental nature of the game changes overnight.
How so?
Well, for the first time in your entire professional life, you are handed a massive pile of free cash flow, the profits generated by the very machine you are so good at running, and you are asked a question you have literally never been trained to answer.
Which is?
What is the mathematically optimal use of this capital to maximize long-term per-share value?
Oh, wow. And their instinct, because of 30 years of deep neurological conditioning, is to just pour that money right back into the machine.
Exactly.
They want to make the machine bigger, louder, and faster.
They fall back on their operational muscle memory. They think, well, I know how to manage 5,000 employees perfectly. So if I use all this excess cash to acquire our biggest rival, and now I have 10,000 employees and double the factory space, I must be doing an exceptional job as a leader.
They are essentially managers who have suddenly, without warning, been tasked with being investors.
That is the perfect way to phrase it. And the tragedy of modern corporate governance is that capital allocation requires a completely different cognitive architecture than operational management. It requires thinking like an unemotional investor.
So we have this tension between the manager mindset, which is focused on scale, activity, and empire building, and the investor mindset, which is focused purely on returns and efficiency.
Right.
Let's get into the actual mechanical plumbing of this. If operational hustle isn't the secret, what exactly is the CEO doing when they allocate capital? I mean, what are the levers they are actually pulling?
We can distill corporate finance down to its most basic structural elements. A company goes through its business cycle. It manufactures a product or provides a service, it pays its vendors, it covers its payroll, pays its taxes, and it maintains its current equipment.
Just the standard day-to-day.
Yeah. And at the end of that cycle, if it is a good business, it has money left over. This is free cash flow. The CEO now stands at a crossroads with that pile of cash. And despite the infinite complexity of the global economy, the CEO has exactly 5 and only 5 primary options for what to do with that capital.
It is remarkable that the entirety of corporate strategy boils down to a 5-item menu. Walk us through them.
Okay. Option 1 is paying a dividend. You take the cash and you literally distribute it directly to the shareholders as a taxable payment.
Handing the cash back.
Got it. Option 2 is buying back your own company's shares on the open market, thereby permanently reducing the total number of outstanding shares.
Okay, buyback.
Option 3 is internal reinvestment. This is taking the cash and putting it back into the existing business. Funding new research and development, building a new manufacturing facility, or launching a new product line.
Growing the current machine.
Right. Option 4 is making an acquisition. You take the cash, and usually some debt, and you buy a completely separate company to merge with yours.
The Wall Street favorite.
Yes. And finally, option 5 is simply using the cash to pay down the company's existing debt, reducing your leverage and your interest payments.
Every single decision the CEO makes with profits falls into one of those 5 buckets.
100%.
To make this tangible for you, the listener, especially if you manage private investments or complex portfolios, let's look at this through the lens of a real estate syndication or a private equity partnership. I think it elevates the math beyond just a personal savings account.
That's a great way to contextualize it.
Imagine you are the general partner of a commercial real estate fund. Your flagship asset is a massive apartment complex. After collecting rent, paying the property managers, covering maintenance, and paying the property taxes, the building generates, let's say, $1 million in pure net operating income this year. As the general partner, you have those exact same 5 options for that $1 million.
So apply the 5 options to that real estate scenario. How does the institutional imperative warp the decision?
Right. Let's go down the list. Option 1, the dividend. You distribute that $1 million to your limited partners as a quarterly yield. They get a check.
Simple enough.
Option 2, paying down debt. You take the $1 million and pay down the principal on the commercial mortgage, reducing your interest burden and de-risking the asset.
Very conservative.
Option 3, internal reinvestment. You use the $1 million to gut renovate the kitchens in half the units, allowing you to charge higher rent next year.
Upgrading the asset.
Right. Option 4, acquisitions. You take that $1 million, use it as a down payment, and buy a smaller apartment complex across town to add to the portfolio.
Expanding the empire.
And option 5, the buyback. You use the $1 million to buy out one of your major limited partners who wants to exit, thereby increasing the remaining partner's percentage ownership of the building's future cash flows without actually expanding the physical footprint of the property.
That is a highly accurate translation of the mechanics. Now, the fundamental problem highlighted in the data is that most public company CEOs, despite having genius-level IQs and massive teams of Ivy League financial analysts at their disposal, are statistically terrible at making these 5 choices.
Really?
Yes. They routinely, almost pathologically, choose the wrong option at the wrong time.
Which begs the question, why? If the math is relatively straightforward and they have the best advisors money can buy, why does a highly compensated CEO consistently allocate capital poorly?
Because the math is straightforward, but the psychology is overwhelmingly complex.
Human nature gets in the way.
Exactly. You have to understand the institutional imperatives and the ego involved. This is what financial historians sometimes call the edifice complex.
The edifice complex, I like that.
A public CEO's prestige, their social standing, their compensation packages, and the way they are covered by the financial press are all intimately, inherently tied to the sheer size of the empire they manage.
Wall Street and the financial media rarely reward quiet efficiency. I mean, nobody gets on the cover of Forbes magazine with the headline, CEO quietly shrinks company by 10%, pays off all debt, and delivers excellent risk-adjusted returns.
Precisely. That doesn't sell magazines. The ecosystem rewards visible, aggressive growth, even if that growth destroys long-term shareholder value. So when a typical manager CEO is sitting on a mountain of free cash flow, their overwhelming psychological and social bias pulls them toward option 3 and option 4.
Reinvestment and acquisitions.
Right. They want to announce a massive internal expansion, or worse, they want to execute a splashy, expensive acquisition. They want buy their largest rival, stand at a podium for a press conference, and be hailed as an industry conqueror by the analysts on CNBC.
But the data on acquisitions is notoriously grim, isn't it?
It is brutal. The vast majority of large corporate acquisitions destroy shareholder value.
Wow.
You generally have to pay a massive premium over the market price to acquire a company, and then the friction of merging 2 distinct corporate cultures, integrating IT systems, and realizing so-called synergies almost always costs more and takes longer than projected.
So why do they keep doing it?
They do it anyway because of the psychological comfort of the herd. Okay. If you make a massive, ill-advised acquisition and it fails, you can usually defend yourself to the board by saying, well, it was the strategic consensus of the industry at the time. Consolidation was the macro trend. We had to make a move.
It is the old adage. Nobody ever got fired for buying IBM.
Yeah.
If you fail conventionally, doing what everyone else is doing, your job is safe.
Yeah.
You can blame the market.
Exactly. Conventional failure is easily forgiven in corporate America. Unconventional success, on the other hand, is viewed with deep suspicion.
That is so true.
But the investor mindset, the true capital allocator, operates completely outside this psychological trap. They are entirely analytical and ruthlessly unemotional. They genuinely do not care about empire building.
They just want the returns.
Right. They do not care if their office is smaller than their competitors, and they actively dislike press conferences. They care about one metric to the exclusion of almost everything else: maximizing the intrinsic per-share value of the business.
Shrinking the denominator.
Yes. If the cold, hard math indicates that the absolute best return on capital is to take all the free cash flow and quietly pay down debt, the outsider CEO will do it without a second of hesitation, even if it makes the company smaller, less exciting, and incredibly boring to the media.
They're just following the math.
They are constantly, continuously weighing those 5 options against each other, asking, where is the highest compounding return for the lowest assumed risk at this exact moment in time?
To really grasp this radical, emotionless investor mindset, we need to look at the absolute purest manifestation of it in the historical record. We need to talk about a man who essentially went to war with Wall Street's expectations, endured years of brutal criticism, and proved the entire financial establishment completely wrong. Let's dive into Henry Singleton and the Teledyne Masterclass.
Henry Singleton is arguably the most brilliant capital allocator who ever lived. He is the ultimate case study for the mechanical power of contrarian thinking. Singleton was the founder and CEO of Teledyne.
Give us the macroeconomic context here. Who was Singleton and what was the environment like when he was building this company? We're primarily talking about the 1960s and 1970s, correct?
Yes, the 60s and 70s. And Singleton's background is crucial. He was not a traditional business executive who worked his way up through sales or marketing.
What was he?
He was a world-class mathematician. He programmed the first computers at MIT. Yeah, he was fundamentally, at his core, a numbers guy who viewed the world through the lens of probabilities and returns. He founded Teledyne in the early 1960s. Now, you have to understand the specific financial mania of the 1960s. It was the era of the great conglomerate boom.
Right, conglomerates.
The prevailing conventional wisdom on Wall Street was that a corporation should aggressively diversify by buying up completely unrelated companies. You would have an aerospace manufacturer buying a company that made toasters, a company that sold insurance, and a company that baked bread.
That makes absolutely no sense.
The theoretical idea was that diversifying operations across completely different sectors would smooth out quarterly earnings, making the stock highly predictable, which would in turn drive the stock price up. It was an era of relentless, chaotic, outward expansion.
It sounds like an absolute nightmare to manage operationally. I mean, how can one executive team possibly understand the nuances of aerospace engineering and wholesale bakery distribution simultaneously?
Operationally, it was a nightmare, which is why the model eventually collapsed. But financially, in the short term, it worked brilliantly. And in the 1960s, Singleton played the conglomerate game better than anyone.
He beat them at their own game.
He really did. Wall Street loved the Teledyne narrative, so they assigned a massive premium to Teledyne stock. It was trading at an incredibly high price-to-earnings multiple. It was a glamour stock.
Very expensive paper.
Exactly. Singleton, looking at the math, realized his stock was overvalued. So he used his expensive stock as an acquisition currency. He issued new shares of Teledyne and used them to aggressively buy up dozens of smaller, highly profitable companies that were trading at much lower multiples.
That's brilliant. He traded his overvalued paper for their undervalued cash-producing assets.
Exactly. He built a sprawling conglomerate, and Wall Street hailed him as a genius because he was playing their game and expanding the empire.
But the macroeconomic environment doesn't stay static. What happens when the music stops?
The music stopped violently in the early 1970s. The U.S. economy entered a period of severe stagflation. The stock market went into a brutal, prolonged bear market. The conglomerate craze completely collapsed as investors realized these sprawling empires were impossible to manage efficiently.
The bubble burst.
Big time. Suddenly, the exact same companies that Wall Street had adored were being relentlessly punished. Teledyne's stock price, along with the rest of the market, plummeted. It went from being a high-flying glamour stock to trading at dirt-cheap, rock-bottom valuations.
And this is the crucible. This is where the genius of capital allocation separates the outsider from the typical manager. If I'm a traditional manager CEO in 1974 and I watch my company's stock price lose 60 or 70% of its value, my primary instinct is sheer panic.
Right, you want to fix it immediately.
I am going to call my PR firm to spin a new narrative. I am going to initiate a massive corporate restructuring, maybe lay off 1/10 of the workforce to show Wall Street I am serious about cutting costs. Or maybe I try to force a desperate acquisition to generate some top-line revenue growth and pump the stock back up. I am going to flail wildly to try and fix the stock price.
Because you were reacting to the market's emotion.
Exactly.
But Singleton did not panic. He simply locked his door, sat at his desk, and looked at the math. Remember the 5 options of capital allocation? He evaluated his position.
What did you see?
He had all these fundamentally sound, profitable businesses he had acquired in the 60s, and despite the stock market crash, Those underlying businesses were still generating massive, steady streams of free cash flow. He had a mountain of cash.
Okay, good problem to have.
But now his own stock was trading at a massive discount to the intrinsic value of those businesses. He ran the numbers and realized something profound. He realized that the absolute highest return on investment he could possibly achieve was not to buy a new business, it was not to build new factories, and it certainly wasn't to pay a dividend.
It was option 2.
Yes. The highest, safest return on his capital was to use his massive cash flow to buy back his own deeply discounted stock.
So he initiates a strategy of repurchasing Teledyne stock. And he doesn't just dip his toe in the water. The numbers here are almost hallucinatory. Over the course of the 1970s and early 80s, through a series of massive tender offers, he essentially vacuumed up his own company from the public markets. He ultimately repurchased and retired over 90% of the outstanding shares.
Over 90%. It is a level of share concentration that is almost unfathomable in today's highly scrutinized corporate environment.
It's insane.
But that wasn't the only thing that enraged the financial establishment. Alongside this massive buyback program, he categorically refused to pay dividends. He never paid a single dividend to his shareholders during this entire period of immense profitability.
Well, I need to play devil's advocate here, representing the perspective of a terrified retail investor or a skeptical institutional analyst in 1976.
Go for it.
If I'm holding Teledyne and I see the CEO shrinking the share count by 90%, not reinvesting heavily in new product lines, and point blank refusing to hand out any dividends to the remaining shareholders, why shouldn't I panic? From the outside looking in, it looks exactly like a company that is entirely given up on growth.
It looks like a retreat.
It looks like a dying empire that is shrinking into oblivion, hoarding its cash, and refusing to reward the people who took a risk by investing in it. Isn't he essentially cannibalizing the future of his own company?
That is precisely the argument Wall Street made, and it is why analysts absolutely despised Henry Singleton during this era. They wrote scathing reports about him. We have to dissect why they hated him because it perfectly illustrates the fundamental flaw in conventional financial modeling.
Okay, let's dissect it.
Wall Street infrastructure demands conventional, predictable behaviors. An analyst builds a financial model based on linear, predictable growth. They want to see a standard dividend payout that increases by 2% every year, and they want continuous, easily explainable outward expansion. You know, Teledyne is using its cash to buy company X in order to enter market Y.
That is a clean, simple narrative an analyst can put in a memo and sell to a portfolio manager.
Exactly. But the narrative of, well, Teledyne is quietly using all its cash to buy its own stock, actively shrinking its operational footprint, refusing to participate in M&A, and giving you zero yield that is a terrible story for a stockbroker to try and sell to a client, it sounds like corporate suicide.
It goes entirely against the herd mentality.
Analysts argued that by executing such massive buybacks, Singleton was tacitly admitting that he had absolutely no good ideas for growing the business organically. They viewed buybacks as a failure of executive imagination.
They thought he was out of ideas.
Right. They argued vehemently that he was starving the company of capital that desperately needed to be utilized for research and development to compete in the future. They believed he was cannibalizing long-term operational health for a short-term financial engineering trick.
But they were fundamentally wrong because they didn't understand the math of the denominator.
That's the key, the denominator.
Let's really unpack the mechanics of shrinking the denominator.
Yeah.
Because this is the specific magic trick of capital allocation that exploded the wealth for the people who trusted Singleton and held on to their Teledyne stock. Let's use a sophisticated analogy to make the math clear.
Let's hear it.
Imagine you and I form a private investment partnership. We gather 10 investors, including ourselves, and everyone puts in $100,000. So we have $1 million in capital divided into 10 equal shares. We use that $1 million to buy a highly profitable mid-sized logistics company. In its first year, the logistics company generates $100,000 in pure free cash flow. Since I own one of the 10 shares, my specific claim on that cash flow is $10,000.
The baseline economics are established. You own 10% of the underlying cash flow.
Now, let's say a massive macroeconomic recession hits. Interest rates spike, inflation soars, and the stock market crashes. A few of our partners panic. They desperately want liquidity, so they offer to sell their shares in our partnership. Because they are panicking, they are willing to sell their shares at a massive discount. Let's say they will sell their $100,000 original stake for only $20,000.
A huge fire sale.
Exactly. As the managing partner, I take the $100,000 of free cash flow the logistics business just generated. I look at my options. I could buy a new fleet of trucks. I could pay out the $100,000 as a dividend to all 10 partners. But instead, I look at the panicked partners selling at an 80% discount. I use the $100,000 in cash flow to buy out 5 of those panicked partners at $20,000 each. I retire those 5 shares. They cease to exist.
You have taken the denominator of outstanding shares and reduced it from 10 to 5 using internally generated cash.
Exactly. Now, let's fast forward to the next year. Let's say the logistics business itself doesn't grow a single inch. The economy is still bad. The business does the exact same amount of volume and generates the exact same $100,000 in free cash flow. From an operational standpoint, the company is stagnant. But look at the mathematical reality of my investment.
The slice of the pie got bigger.
Because I retired 5 shares, there are only 5 shares left in existence. My single share, which previously entitled me to 10% of the profits, now entitles me to 20% of the profits. My individual claim on the earnings just went from $10,000 to $20,000. The underlying intrinsic value of my specific share just doubled, completely independent of the company's overall operational growth.
The pie didn't get bigger, but your slice of it doubled.
Yes, because we aggressively shrank the number of slices while the cost to do so was irrationally cheap.
That is the precise mathematical mechanism Singleton weaponized, but he did it on a massive, multi-billion-dollar corporate scale. By shrinking the outstanding shares by over 90%, he was taking the immense, steady cash flows generated by his mature businesses and relentlessly concentrating them into a smaller and smaller number of shares.
Just elegant math.
It is. For the shareholders who possessed the fortitude to hold on and trust his math, their proportional ownership stake in Teledyne's profits was multiplying exponentially every single year without Teledyne actually having to launch revolutionary new products or capture new market share. It is the ultimate vindication of the analytical investor mindset over the expansionist manager mindset.
The results are the ultimate proof of concept. The data laid out in the research is genuinely breathtaking. Between 1963 and 1990, a period spanning 27 years, if you had taken your money and invested it broadly in the American economy by buying an S&P 500 index fund, your investment would have grown by 15 times.
That is an exceptional return. That encompasses massive economic expansions, the rise of the personal computer, the entirety of the 1980s bull market. A 15x return over a quarter century is highly successful.
It's what everyone hopes for in their retirement account. But if you had invested that exact same capital alongside Henry Singleton, enduring the criticism, the zero dividends, the constant stock buybacks, the utter lack of conventional growth, your investment did not grow by 15 times. It grew by 180 times.
A 180x return. It is almost difficult for the human brain to fully comprehend that scale of compounded outperformance.
Yeah.
To put it in absolute dollar terms, a $10,000 investment in the S&P 500 would have matured into roughly $150,000.
Right.
That exact same $10,000 invested with Henry Singleton turned into $1.8 million.
It obliterates the market. And the supreme irony is that he achieved this while the foremost financial experts of the era were screaming from the rooftops that his strategy was cannibalizing the company.
Because the experts were measuring the wrong variable. They were measuring the sheer size of the company's operational footprint. Singleton was exclusively measuring the per-share intrinsic value.
He knew it mattered.
The central takeaway from the Teledyne Masterclass is that aggressive, contrarian capital allocation, when executed with mathematical precision and total emotional detachment, is vastly more powerful than standard operational growth. Singleton proved definitively that you do not need to invent the iPhone to create historic, generational wealth. You simply need to buy your own highly profitable assets when the market is irrationally mispricing them.
Singleton's math is bulletproof. But he wasn't the only one who figured this out. It turns out that the most famous investor in modern history, a name that is synonymous with wealth creation globally, utilized this exact same underlying philosophy to build his empire. That transitions us beautifully to the next massive figure in this analysis. Let's talk about Warren Buffett, but let's talk about him not as a stock picker, but through the specific lens of an outsider CEO.
Framing Warren Buffett as a CEO rather than just a portfolio manager is one of the most vital insights of this research. We traditionally view Buffett as a savant who sits in Omaha and picks winning stocks for his portfolio. But to truly understand his wealth creation, we must view him as the ultimate capital allocator presiding over a corporate structure.
To understand Buffett through this specific lens, we have to rewind to the origins of Berkshire Hathaway. Today, everyone conceptualizes Berkshire Hathaway as this invincible $800 billion colossus. It owns massive insurance conglomerates like Geico, major railroads, energy infrastructure, Dairy Queen, and holds staggering equity stakes in companies like Apple and Coca-Cola.
It is a pillar of global capitalism.
Right, but the foundation of that empire was built on something completely different.
It was built on a dying business.
Literally.
In the mid-1960s, Berkshire Hathaway was a failing textile manufacturing company based in New England. It was a fundamentally terrible business operating in an industry that was rapidly being decimated by cheaper foreign competition and shifting labor costs.
So why did he buy it?
Buffett initially bought control of it simply because the stock price was statistically cheap compared to the liquidation value of its assets, a classic cigar butt investment. But he quickly realized the fundamental economics of the textile business were permanently doomed.
And this is where the divergence between a manager and a capital allocator becomes stark. A traditional manager CEO, raised in the textile industry, would have spent the next 20 years desperately trying to execute a turnaround.
Oh, without a doubt.
They would have poured millions of dollars of retained earnings into upgrading the looms, hiring expensive management consultants, trying to launch premium fabric lines, or aggressively marketing to new distributors. They would have bled the company dry trying to save the core operation because their ego was tied to being the CEO of a textile manufacturer.
They would have stubbornly thrown good money after bad, attempting to fight a macroeconomic tide that was impossible to beat. But Buffett, functioning purely as a capital allocator, looked at the situation analytically. He realized that any capital reinvested into the textile mills, option 3 on our menu, would generate an abysmal, likely negative return on invested capital.
So what did he do?
So he made a ruthless, highly unemotional decision. He completely stopped reinvesting in the mills. He essentially let the textile operations slowly run off, extracting whatever marginal free cash flow it still generated. And he took that cash and allocated it entirely outside the textile industry. He began buying insurance companies.
He took the dying profits of a structurally flawed business and mercilessly reallocated them into businesses with superior economics. And over decades, he transformed a failing textile mill into a multi-billion-dollar conglomerate entirely through superior capital allocation.
It's an incredible pivot.
But what I really want to dig into is a specific ironclad policy of Buffett's that ties directly back to Singleton and the core philosophy of the Outsiders. It is Buffett's unyielding stance on dividends.
Yes, the zero dividend policy. It is one of the most defining characteristics of Berkshire Hathaway. Warren Buffett has never paid a dividend. He instituted a strict zero dividend policy from the moment he took control, and he has defended it vigorously for over half a century.
Which again flies completely in the face of traditional corporate finance theory. For decades, institutional investors, pension funds, and retail shareholders have demanded dividends.
It's what people expect.
The standard dogma is that when a company reaches maturity and generates massive profits, it is practically a fiduciary duty to return cash to the shareholders via dividends as a signal of financial strength and respect for the investor. If you don't pay a dividend, Wall Street assumes you are hoarding cash because you are paranoid.
But we have to look at the math and the philosophy behind Buffett's zero dividend rule. It is a masterclass in rationality. Buffett argues that a dividend, fundamentally, is an admission of failure by a corporate executive.
Wait, really? A failure?
Yes. When a CEO declares a dividend, they are effectively communicating to the shareholder, well, here is your portion of the profits. I am distributing it back to you because I cannot find any internal reinvestment opportunities or external acquisitions that will generate a high enough return to justify keeping it. My ideas are exhausted. You take the cash because you can probably invest it in the broader market better than I can deploy it internally.
That is an incredibly sobering translation of what a dividend actually represents.
Yeah.
It is the CEO admitting they have run out of profitable ideas.
It is the brutal mathematical truth. But Buffett evaluates his own track record. He understands his unique skill as a capital allocator. His philosophy is remarkably simple and deeply arrogant, but mathematically justified. He believes that if he retains that $1 of profit inside the corporate structure of Berkshire Hathaway, his skill allows him to compound that $1 into $2, $4, and eventually $8 over time.
He backs himself to beat the market.
Exactly. If he were to distribute that $1 back to you as a dividend, you immediately suffer a tax drag. You pay taxes on the dividend, leaving you with perhaps 80 cents. Then you have to take that 80 cents and go out into the market to find an investment that will out-compound Warren Buffett.
Good luck with that.
Right. Frankly, the statistical probability of the average investor finding a better risk-adjusted return than Warren Buffett is essentially zero.
So the absolute best thing the investor can do is simply leave the capital in Buffett's hands to compound tax-free internally. The logic is flawless. So we have established the theoretical framework. The math works. Shrinking the denominator like Singleton works. Zero dividends combined with high return internal compounding like Buffett works. The investor mindset obliterates the operational mindset.
The results speak for themselves.
But this brings me to a highly practical question. How do these leaders actually structure their daily lives and their corporate hierarchies to execute this? If they're explicitly refusing to micromanage daily operations, what are they actually doing all day? How do you operationalize this philosophy?
That is where the research transitions from abstract financial mechanics into corporate culture and organizational behavior. Thorndike identified a highly specific outsider playbook that was shared not just by Singleton and Buffett, but by all 8 CEOs in the study again, people like Katharine Graham at the Washington Post, Tom Murphy at Capital Cities.
They all ran their companies the same way.
They didn't really share financial strategies. They shared distinct, deeply ingrained behavioral and organizational philosophies. And the 2 most critical pillars of that playbook are extreme frugality and radical decentralization.
Let's tackle frugality first, because I think it is easily misunderstood. When we describe these billionaires as frugal, we aren't talking about them clipping coupons or buying cheap office coffee. We're talking about structural corporate frugality. The research notes that these outsider CEOs almost universally abhorred corporate perks.
They hated them.
They had no corporate jets, no sprawling executive dining rooms, no massive armies of PR consultants, and they refused to build monumental corporate headquarters.
That is correct. If you picture a massive global conglomerate like Berkshire Hathaway or Teledyne, you naturally imagine a sprawling corporate campus with thousands of headquarters employees, layers of middle management, and immense overhead.
A mini...
Exactly. In reality, Buffett runs Berkshire Hathaway, one of the largest companies on Earth, with a corporate staff of roughly 24 people. They do not have a centralized legal department, they do not have an HR bureaucracy at headquarters, and they operate out of a highly modest, nondescript office building in Omaha. Similarly, Tom Murphy ran Capital Cities, a massive media empire with an incredibly skeletal corporate staff.
But I want to scrutinize the logic here. Why does this level of extreme frugality actually matter to the bottom line? Obviously, it saves money. But a corporate jet costs, let's say, $5 million a year to operate. For a company generating billions of dollars in free cash flow, a private jet is literally a rounding error. It does not meaningfully impact the earnings per share.
That's true, purely on the math.
So why are these capital allocators so obsessively, almost aggressively frugal about things like perks and office space?
Because you have to view frugality not as an accounting mechanism, but as an intellectual discipline. It connects directly back to the core concept of capital allocation. For these leaders, frugality isn't about saving pennies to marginally boost quarterly earnings. It is a physical manifestation of their underlying philosophy.
A signal to the rest of the company.
Exactly. Remember, their entire worldview is predicated on maximizing the return on every single dollar of capital. To a true capital allocator, a corporate jet isn't just a convenient perk. It is a visibly, wildly inefficient allocation of shareholder capital.
It is a physical symbol of waste.
It sends a profound, unavoidable message to the entire organization. If the CEO is willing to casually set millions of dollars on fire for the personal convenience of flying private, or to stroke their own ego with a massive corner office, it establishes a cultural precedent that capital is cheap and can be wasted on vanity.
It trickles down.
It essentially gives permission to every middle manager in the company to start expanding their budgets unnecessarily, to hire superfluous staff, and to prioritize comfort over efficiency. But if the CEO is brutally disciplined about small expenses, it enforces an ironclad culture of discipline for the massive capital decisions. Frugality is the visible, daily proof that the leader treats the shareholders' money with absolute respect. It serves as cultural armor against the disease of the Oedipus complex we discussed earlier.
That makes perfect sense. The culture flows from the allocation of the smallest dollar. Okay, so that's just frugality. The second major pillar of the outsider playbook is decentralization. The data highlights that these CEOs ran radically decentralized operations. They aggressively pushed operational decision-making down to the lowest possible level of the organization, usually to the managers actually running the subsidiary businesses.
Yes, push the power down.
And the CEOs themselves stayed completely deliberately out of daily management.
Yes. The model was incredibly consistent across all 8 figures. They would acquire a company or identify a highly competent manager within an existing division, and they would hand them the keys.
Just let them run it.
They essentially said, you run the business, you figure out the marketing, you handle the hiring, you manage the supply chain, we will set the financial return targets, and we will handle the capital you generate, but we will not tell you how to do your job.
No micromanaging.
None. They did not hold endless, agonizing weekly check-in meetings. They did not dictate strategy from headquarters. They set the parameters and stepped away.
I am trying to reconcile this. If they are pushing all the daily decision-making down to the operating managers, if they are refusing to manage the day-to-day friction, if they aren't setting the marketing strategy or dealing with personnel issues, aren't they essentially just portfolio managers masquerading as corporate CEOs?
That is the crucial insight of the entire analysis.
So it really...
Yes. That is exactly what they are, and that is precisely why they were so phenomenally successful. You have just articulated the secret architecture of their outperformance. The greatest CEOs in modern business history did not actually function as CEOs in the traditional operational sense. They function as elite portfolio managers overseeing massive, captive pools of permanent capital.
Let's dig deeper into the strategic advantage of that structure. Why is it so vital that they functioned as portfolio managers rather than operational leaders? What is the specific edge gained by refusing to manage?
It comes down to the optimization of the most precious, finite resource a human being possesses: mental bandwidth.
Mental bandwidth.
Consider the traditional CEO, the ship captain we visualized earlier, white-knuckling the wheel. Their daily calendar is a nightmare of context switching. Their day is entirely consumed by 1,000 immediate operational fires. A key supplier in Asia is delayed. The labor union is threatening a strike at a Midwestern plant. The new software product has a critical bug right before launch. The head of marketing is resigning.
Just a barrage of problems.
They are spending 95% of their mental energy reacting to the daily friction of the machine.
They are constantly exhausted by the noise of the present moment.
Precisely. And when your cognitive bandwidth is completely saturated by operational noise, when you are constantly putting out immediate fires, you literally do not have the quiet, uninterrupted time necessary to think deeply about complex, long-term mathematical probabilities.
You can't see the forest for the trees.
You do not possess the emotional distance required to make cold, rational decisions about capital allocation. If you have spent the entire morning in a screaming match with your legal department over a minor lawsuit, you are simply not in the correct psychological state to objectively analyze whether you should shrink your outstanding share count by 90% or acquire a new insurance subsidiary.
So, by executing radical decentralization, by handing the operational keys to highly competent general managers and explicitly telling them, look, do not call headquarters unless the building is literally on fire, these outsider CEOs ruthlessly cleared their calendars.
They systematically freed up 100% of their mental bandwidth. They isolated themselves from the chaotic noise of daily operations. And this deliberate isolation is what allowed them to cultivate the other vital traits highlighted in the research. Being deeply analytical, fiercely independent, and highly opportunistic. You cannot be an opportunistic apex predator waiting patiently for years for the perfect macroeconomic moment to strike when asset prices are irrationally low if your daily schedule is choked with HR disputes and marketing reviews.
They intentionally designed an environment where their primary professional responsibility was simply to read, to think, to study the underlying economics of various industries, and to wait patiently for a fat pitch.
Exactly. It provided them with the profound clarity necessary to be independent thinkers, unburdened by the emotional consensus of their peers. When the entirety of Wall Street was screaming at Henry Singleton to stop buying back Teledyne stock, he was able to calmly ignore them because his mind wasn't cluttered with 100 other operational anxieties.
He wasn't stressed out by the daily grind.
He had the quiet, unshakable confidence of a mathematician who has rigorously done the math in a silent room. He wasn't swayed by the panic of the herd because he deliberately chose not to live within the herd.
It is almost a monastic approach to business leadership. The immense discipline required to stay away from the shiny objects of daily management, to resist the urge to meddle, so you can focus entirely on the underlying invisible architecture of long-term value creation.
That is a highly accurate characterization. It requires a monastic dedication to rationality and an ego secure enough to do nothing for long periods of time.
As we start to synthesize this deep dive and bring it full circle, I want to reiterate the absolute paradigm shift that this data represents. We started this conversation by picturing that charismatic, table-pounding general, the Steve Jobs or Jack Welch archetype.
The standard CEO image.
And obviously, it is undeniable that there are visionary founders who succeed wildly through sheer force of will, product genius, and relentless operational intensity. But the objective data, the hard, undeniable mathematical reality of compound wealth creation across multiple decades proves that great leadership is rarely loud.
It is rarely about being on the cover of a financial magazine.
And it is certainly not about constantly launching new, flashy initiatives just to project an aura of busyness.
The historical data proves definitively that the most potent combination in business history is being quiet, deeply analytical, and deliberately contrarian. It is about possessing the intellectual courage to look at what every other company in your industry is doing, look at what Wall Street analysts are aggressively demanding, and if the math tells you the crowd is wrong, you calmly, decisively walk in the exact opposite direction.
Stick to your guns.
You allocate capital exclusively where it generates the highest risk-adjusted return, even if it makes you deeply unpopular or misunderstood in the short term.
It is the ultimate triumph of substance over style, of the cold, rational investor mindset over the frantic, expansionist manager mindset. And it leaves me with a final, somewhat provocative thought, something for you, the listener, to mull over long after this deep dive ends. We have spent this entire time talking about billionaires, historical corporate titans, and massive conglomerates allocating billions of dollars of financial capital. But the underlying structural principles of the outsider philosophy apply to all of us, regardless of our profession, because we all have a finite pool of capital to allocate.
Time and attention are the ultimate forms of capital.
Exactly. Look at your own career trajectory. Look at the way you manage your own small business, or simply examine the architecture of your daily schedule. Ask yourself a very hard question. Are you spending all your energy white-knuckling the steering wheel? Are you entirely consumed by the daily operations of your life, answering every email the second it arrives, attending meetings where you provide no distinct value, chasing every minor urgent task just so you can feel productive and look busy to the people around you? Are you trapped in the exhausting cycle of the manager mindset?
Or are you possessing the discipline to step back?
Right. Are you stepping back, going below deck to the quiet cabin and thinking like an investor? Are you ruthlessly, analytically allocating your most valuable, entirely non-renewable capital, your time, your deep focus, your mental bandwidth away from the low-return noise of the present moment and toward the high-return, long-term investments that will actually alter the compounding trajectory of your life? Are you brave enough to intentionally shrink your commitments, to decentralize your daily fires, and to quietly do the math on what actually matters?
That is the true lasting lesson of the outsider philosophy. It is a framework for optimization, whether you are running an $800 billion conglomerate or simply trying to optimize your own potential.
It completely changes everything about how you view success and efficiency. Thank you for joining us on this deep dive today. Keep questioning the conventional wisdom, keep analyzing the underlying numbers, and above all else, remember to think differently.
So friends, that was the complete breakdown. Make sure to take a screenshot of this growth gift, this infographic, so this lesson stay with you. If you want to learn from legends every single day, join our community. I am Amin. Always remember, read more, think deeper. Let me know in the comments who we should cover next. See you in next episode.